Welcome to the Women in Wealth podcast, brought to you by Regina McCann-Hess, a certified financial planner with over 2 decades of experience. This show is for professional women who want guidance in working towards their retirement vision in learning, building, planning, striving for your dreams, and putting the work in now so that you can pursue your financial independence. Hello, I'm Regina McCann-Hess, president of Forge Wealth Management, and welcome to our Women in Wealth series. Today, we're going to talk about the market. Oh, fun topic, right? A lot of up and down recently, a lot of topsy-turvy. I'm sure you're kind of like tired of talking about it or don't want to talk about it, and you just want to maybe burrow into a hole. And hey, that might be the way to go, but maybe not. Maybe you want to have a little bit of education around it. It's also kind of hard to stay calm when you're bombarded by news and a lot of news, and you turn on the radio, you turn on the TV, and it's about the economy, it's about the stock market, it's about the tariffs. That's referring to the T word now, right? The tariffs have a big part in the speculation of the markets right now. So we're going to talk about that a little bit today. And anxiety about your portfolio could definitely creep in. And then before you know it, you have the media barrage going on and possibly turning your anxiety into panic. So that's what we want to kind of contain a little bit. Also, investing has become a little bit more complex over the years. And we want to make sure that you don't have any emotional reactions to the market, because that can create even more issues for you. But we also know that market volatility is actually normal. Yeah, I said it. I did. Market volatility is normal. Do we like it? No, absolutely not. We like it when the market goes up. We don't like it when the market goes down, right? However, it's part of the beast. It is part of what happens. It can't just be a straight up. There's got to be like checks and balances in the system. And it has to reset every once in a while. Now, right now, we've had some serious reset over the past 2 months, and it gets uncomfortable, right? But that's okay. If we are looking at long term and thinking long term, then we find ways to handle that. Our short term money, usually we have some money that is not in the stock market for our short term needs, our cash flow needs. So it gives us a little bit more time for that market recovery and for that volatility to kind of die down. So we are going to talk about 10 pillars or principles of long term investing resilience. So bear with me as we go through the conversation, and sometimes a little education about, what's going on behind the scenes may be helpful. So our first point is understanding market movements. Obviously, the markets are pretty resilient. History has shown many of the declines don't last. And some people get nervous. Oh my goodness, it's going to be different this time. If I had a penny or if I had a dollar for every time somebody said, well, this time it's different. You think back over all of our lifetimes, all the bad things that have happened, all the bad markets. And we think, every time it happens the next time, we think, oh my gosh, it's never going to recover. It's going to be different this time. But think about some of the really, really rough times that we've had. 2008, that was rough. After 9/11, really, really scary. We thought the world was coming to the end for us, right, as a country. 2002 and 2000, that whole tech bubble in there as well. Right around COVID, when we had the downturn then. I mean, those are more recent times. We can go back even further. But those are some things where, when we live through it, you're like, oh, crap, what is going on here? But it happened and we got through it, right? Was it fun going through it? Heck no, but it is a part of the process. It can't always go up, but if we are smart about how we get through it, then long term, we tend to do a little bit better than people who have emotional reactions. And now you have to think about where we have a sell-off or a correction or even a bear market, whatever it's called, it happens. It can be unsettling. It can be, give you same anxiety. But again, time after time, the stock market has recovered. It's disruptive, but it's usually short term. And what does short term mean? That doesn't mean a couple of days. It could be a couple months. It could be a year. It could be a year and a half. I mean, I know in 2008, that recovery time was quite a while. So we just want to know, what are the timeframes of that? How long do we expect it to recover? And knowing what the market movements are. We again just look back at the history of the market, and if you have a financial advisor, ask them to give you one of those pretty little charts that shows all the bad things that have happened over the years and how it has impacted you, your portfolio, and the markets over time. In the short term, doesn't look too pretty, does it? But in the long term, overall, not an awful situation, right? So, but what is a really rough thing to do that could have a long term impact would be while you're in the middle of this volatility, moving out of stocks and locking in those losses. Now, that may prevent you from recovering from that market loss if you do things like that. So that's one of the things that we want to prevent you from doing by just talking about what are the things you should do and shouldn't do. And having an emotional reaction in a market like this can be a little adversely effective on your portfolio. The key thing to keep in mind here is nobody's going to ring the bell so you're getting emotional about, oh my goodness, the market's going down. I need to get out. I need to get out. And I understand that there's a little bit of panic there, but calmer heads prevail, right? Because if you get out, and this is what a lot of people do, they get out of the market and then they wait on the side of the market until things get better. And then they go back in when the market's better and they miss that uptick. So they're selling at a low and buying at a high again, and it's counterproductive to long-term performance. So that's just one thing I like for people to keep in mind. The second item on the list is, and I kind of already let this cat out of the bag, volatility is normal. Historically, bull markets have actually beaten bear markets and driven long-term gains, but it's not been just a straight uphill. It's been a little bit up, down, up, down, up, down, up, down, like a kind of climbing a mountain where there's like little cliffs and valleys and things like that. So obviously a lot of problems in between there, but we have plenty of history that shows over time the market does do pretty well. Markets are always moving, whether or not they're going up or down or even sideways, they're always moving, but they're rarely just going straight up. Now we get a little spoiled, like especially the past 2 years, we had straight up double-digit growth for 2 years. And then, then we have the reality check of market volatility and we get a little like, ooh, why is this happening? It's normal. Okay, so over time, stock markets have definitely moved higher. They've bounced back from what would appear to be short-term declines. And here's the thing, if you sell while the market is failing, you're likely to miss a rebound. And of course, any substantial gains that could be part of that rebound. So investing for the long term and having a disciplined plan can actually help you reach your goals a little bit better than having those emotional reactions. Okay, so number 3, you control your emotions and behavior, right? The average investor, however, has underperformed. So if you look at the reports of, we'll use the S&P 500, what the return was versus the bond index, but versus the average equity fund investor. The S&P return has been roughly 10.92%, and the average equity investor has been about 10.05%. And that is a lot of that has to do with people having emotional responses to market volatility. So you want to talk this through with your financial advisor. You want to allocate maybe and diversify and maybe rebalance your assets accordingly. You also want to review your overall investment portfolio at least annually to help you keep focused on your course and your goals. The other thing you want to think about is choosing investments that are aligned with your goals and of course, your risk tolerances. It's easy to say, hey, I'm comfortable with average or above average risk when the market's going down. And when the market comes down, you're like, ooh, that doesn't feel really good. I don't think I'm an average risk person or above average risk person. So you have to know that about yourself and be willing to make pivots when you can make pivots. And just because the market's down, we don't want to make emotional reactions and sell and go to cash. That doesn't mean maybe you need to make some adjustments within the portfolio. Only you and your financial professional can take a look at that and make those decisions. But obviously going from equity to cash is probably not going to help you here. You want to stay focused on the goal and the long-term plan and knowing what your money is being used for and the time frame for that money as well. So in that regard, the fourth item is to take a longer view. Some of our goals are shorter term and some of our goals are longer term, but building wealth actually takes time. It's not something that you do overnight. Stocks have, if you look over the past 20-year period, they've returned positive returns over 100% of the time. Now, obviously, there's downturns in there, but when you look at it over the whole time frame, you have some positive time there where your money worked for you. So that's why we talk about think long term. On the shorter time for that, only 74% of the time the market was up, and a 5-year term period was the market was only up about 84%. So, you do have to keep in mind the time frame for the markets and the time frame for your goals and for your money. So that is very, very important for deciding how to invest your money, because you don't want to invest your money in the stock market if you need it in a year. That's just letting off a little bit more than you want to. That's very, very risky. It's more like your retirement money. It's, 10-year goals, things like that. That's probably more realistic to be able to withstand some more of that volatility. So historically, investing in stocks has been one of the best ways to build wealth because of long-term growth potential related to cash, bonds, and things like that. A lot of people actually do underinvest in stocks, or they also try to time the market, which is not really effective either. You're definitely missing opportunities when you do things like that. And that's because literally, like when you look at the research, it's over the long periods of time that the stock market has generated positive returns. So number 5, we're going to talk about compounding and how that works. So this is something you hear all of us financial professionals talk about, compounding your money and over time, and it drives value, things like that. So that's basically your money, over a long period of time. And the earlier you save, the earlier you invest, the better outcomes you have. So the power of compounding, let's take an example of that. So if you have a hypothetical $10,000 investment and you have, assuming a 5% return over a 10-year period, that $5,000 or $10,000 is going to grow to $16,289. If that same $10,000 is over 20 years at that 5% number, you're looking at a value of $26,533. So that's a big difference. And obviously, if you have a lower rate of return or a higher rate of return, that's going to determine, the values of your money. But it's essentially the earlier you get your money in and saving and investing, and the longer it has to cook, as I like to say, usually the better the outcomes. So we're assuming all that also with, reinvesting the dividends into the earnings and whatnot. So we want to also assume that we're getting gains from those holdings and we're just reinvesting that, which also helps the portfolio grow. Now, treasury bills, bonds, they're not going to provide the same growth potential that the stock market will. So you do want to be aware of that. You also, will have higher volatility in equities. Could be, you could go as aggressive as you want, like 100% stocks, but know that when we get into volatile times, your portfolio is going to look like, a roller coaster. And at the end of the day, long-term money should be okay, but you want to be careful about the risk. You don't want to go throw it all on black at the casino, right? You have to have some thought behind it. You have to think about what your goals are for the money. What is the time frame for those goals and how comfortable you are taking risk? So that's the one items on number 5 there. Item number 6 is diversification benefits. And if you have a financial advisor, they always talk about like diversification. And I refer to it as Baskin Robbins 58 flavors, because you don't want to have all of one thing or too much of a one thing, because then too much of one thing can actually be a detractor. Because on the way up, those big productive stocks look great. You're like, oh gosh, I wish I would have bought that. But on the way down, you're like, ooh, Nelly, that's awful, right? So you don't want to have all of your eggs in that one basket. So things work until they don't, because what worked great last year may not work so well this year. And they all basically take their turns. Like you could have international, you could have large growth, you could have small value. all these different sectors of the market, they're going to do better than others throughout time. It's not going to be the same one every single year. So that's why you have a little bit of a diversification throughout your portfolio, including bonds, right? And alternatives maybe. So that is going to help your allocation even better. So the asset class with the best performance, like I said, changes from year to year and from decade to decade. And trying to consistently pick the best performing asset is pretty much almost impossible, especially when we let emotions get involved. So we want to be careful with that. So that is diversification. I'm all about diversification. Yes, it's great to have companies that are like going to the moon when the markets are up, but when the volatility is high, those are very, very uncomfortable moments. So that's why you want to have, wide range of different types of holdings and asset classes in your portfolio. Number 7, investments should align with your goals. All right, am I repeating myself here, right? What is the time frame for your goals? Is this money short-term, long-term, intermediate? When do you expect to have to take money out from this portfolio? Over time, your focus as an investor pretty much shifts from growing your portfolio to preserving it. You're going to build that little nest egg, keep building, keep building, keep building. And then eventually you get to the point where you're like, oh, okay, well, now that I have this nice big sum, I want to protect it. I want it to still be here, but I want to like maybe put some belt and suspenders or bubble wrap on it as much as I can. Right. As far as you know, and as far as I know, if you are in the stock market or even the bond market, there are no guarantees. You can lose money, you can make money. There's no guarantees that you're going to make a certain dollar amount, certain percentage, because you're going to gain and you're going to lose. So just know that going in, and knowing what the time frame of your goals is should really maybe kind of lead you to what kind of allocation, and by that I mean how much stock or how much bonds you should have based on your time frame there, and also of course alternatives. So you do want to consider aligning your asset allocation with your goals. Equities for growth, bonds for income and risk mitigation, and also considering alternatives for some of that mitigation as well. You want to determine how much money you should withdraw annually when you are retired. That's also very important. And, thinking especially when you get to the age where you have to start taking required minimum distributions, that is a whole nother conversation about, how much cash should you have on hand to make sure that you have enough money for that required distribution. And then obviously the more you take out of your savings could determine how long that money is going to last for you. So you want to be very cognizant of that as well. So if you did, the more you take out, obviously, the quicker you're going to burn through your portfolio. So you obviously want to do some planning with your financial planner, somebody like me, and see, what does it look like? How long do I think my money is going to last? Will it last at age 90, 95? Or, at age 82, am I going to be on a cardboard box in the street? There's no joke. I mean, I make a joke of it, but it's really no joke. You have to think about these things. And, just by tweaking a couple things, like maybe retiring a year or two later, or spending as much in retirement could determine, how your probabilities for making that money last will be true or not true by some of the choices that you make along the way. So very, very important conversations that you do need to have. Importance of rebalancing. This is our 8th pillar here. We don't want to make unintended bets, right? You want to consider rebalancing your portfolio. Obviously, hindsight, at the end of the year would have been a great time. Is it time to do that right now? Probably not, because you don't want to sell your equity into a down market. But once the market does recover, that might be a lesson that you have learned. If you haven't been through a lot of bear markets, after you've been through a couple, usually throughout the time frame, you take some gains off the table as you can get them, right? We're not always going to have gains, but when we do, maybe we want to redeploy some of them. So the relative market performance of asset classes, like I said, shifts over time, and that could alter your portfolio's mix of investments as well. So if in the past 2 years where equity was really, really good and we had that double-digit growth, you could have had a 50-50 portfolio, and for a couple of years that then got to be more like a 60-40 portfolio, and now you might need to take 10% off of equity and put it back to bonds to get back to that 50-50, and that was just your gains that you have to like take care of to make sure you stay in that balance, assuming, 50-50 is your number. I don't know what your number is. That's something you want to talk about with your financial advisor. And that also goes into your risk and your time frame. I keep saying the same things, right? It all kind of blends in together. So that's one of the things that we want to make sure you're aware of as well. Okay, number 9, understanding risk is critical. Determining the risk in your portfolio may make the difference in pursuing your goals. You want to navigate risk from all the angles. What you're, again, your time horizon, your culture, your values, active risk management, your capacity management. Why you can't avoid risk 100%. You just can't. It's there. It's the nature of the beast. Understanding its nature is something that you may be able to manage. So understanding the market volatility, understanding why it happens, understanding, how it has happened in the past and how you've handled it in the past, and what do you need to do to make it a little bit of different this time. Do you want to engage with your financial advisor to talk through it before making any knee-jerk reactions? So you also want to think about how your asset manager or your financial advisor does tackle risk. So that's something to really, really think through. We want to talk about that. You want to talk about it if you're in a relationship or you're shared your investments with somebody in the family. That's something that is not a one-person conversation. It's a two-person conversation, and sharing what is important to both of you in the portfolio and overall health of your portfolio and risk management. So number 10 is realize the benefits of working with a professional. Okay, well, this is a little self-serving. Working with a financial advisor can add a little bit of comfort. We try to help avoid some of the costly mistakes. We aim to keep you on track while pursuing your goals. And we also talk a lot about long-term goals, moving you forward, thinking about the big picture, what's important for you, what's important for your family along those lines. So those are the things that we do. And, I will say during times of market volatility, that's really where we earn our money. We should be calling you. We should be like having a conversation with you like, hey, how are you today? How are you feeling? Oh, did you see the market? Yes, we're going to talk about that. And here's what I think is going on. Here's why I think the market's reacting this way. How long is it going to last? I don't know. I really don't. But it can't go on forever, right? So just talking through it, not that I have the right answers, but talking through it just and knowing that you can talk through it and have a plan of attack can be helpful to everyone involved. So a lot going on there. Stay tuned. You might need to fasten your seatbelt a little bit as we get through the tariff conversations. Long term, I believe it's worth it. I've been through a lot of bear markets. I'm not saying this is a bear market. I've been through a lot of volatility. How about that? And the one thing is that eventually the sun comes out eventually on another day and we start looking good in the stock market again. So think long term. The other thing, and this is going to be the action item today, the other thing to think about is, yeah, you know what? The market's down. What could I do while it's on sale? If you have a plan and you have cash, maybe you're dripping into this market, right? The one place you are dripping into this market is your 401k. If you're still working and you have 401k contributions, guess what? You're doing the right thing. You have money dripping into this, into the 401k, into the stock market, assuming you've picked funds that have stocks in them. You're buying things that are really on sale right now. Could they go lower? Sure, they could, but you're not buying them at the high that they were a couple months ago. So you're dripping into or dollar cost averaging into this market, which is one of the best things you can do. And I will tell you, in 2008, when the markets were just a mess and making my phone calls, talking to my clients, things like that, I looked at my 529s. Now, granted, at that point, my kids were very young, but I had been saving the 529 since my oldest was born. And so it was several years, and it was a lot of effort to make those payments or, contributions to the 529s. And I would look at the statement and I would literally feel like somebody kicked me in the stomach. It was awful. Guess what? What did I do? I kept contributing every single month to those 529 plans. That's what you need to do if you have long-term goals. If you have 529 plans, your 401k plans, your rainy day savings, things like that, you got to just keep doing the right thing. You got to stick with your plan. And at the end of the day, later on. It might be a couple months, it might be a couple years. But when you look back, you'll be like, oh, I'm so glad I did that. I did all the right things. And now the market's up and I look like I knew what I was doing. And that's like a little conversation I had with myself. Even though I'm a financial advisor, I had to have a conversation with myself and say, listen, girl, hey, the market's down. You're going to be down too, right? It's your 529s. You just keep dripping money in there like you would normally do. It's discounted. You're buying more shares, so it's going to be worth more at some point. And I also didn't need the money at that point anytime soon. Now, however, I am using it. So that's a whole nother conversation, right? But long-term money, you want to make sure that, you're dripping in and taking advantage of these market downturns. Okay, thank you for listening. I appreciate your time today. Again, I'm Regina McCann-Hess, president of Forge Wealth Management. My website is forgewealth.com. You can find me on Facebook, YouTube, and Instagram at Forge Wealth. LinkedIn is Regina McCann-Hess. And I appreciate your time today. I also want to thank you for watching today. We appreciate you. You can also on my website see the founders video that I created for you to learn more about me and how I can guide you towards your financial independence at www.forgewealth.com. This information in the podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. This material was prepared using MFS Fund Distributors Inc. information, and they are not part of Private Advisor Group, LPL Financial, or Forge Wealth Management. This information is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Securities offered through LPL Financial, member FINRA, SIPC. Investment advice is offered through Private Advisor Group, registered investment advisor. Private Advisor Group and Forge Wealth are separate entities from LPL Financial. Our show guests and their companies or our companies that we are using like MFS for information are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management. Thank you and have a great day. Thank you for joining me for this episode of the Women in Wealth podcast. You can watch the founders video I created for you to learn more about me and how I can guide you towards your financial independence at www.forgewealth.com. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. Securities are offered through LPL Financial, member FINRA, and SIPC. Investment advice offered through Private Advisor Group, a registered investment advisor. Private Advisor Group and Forge Wealth Management are separate entities from the LPL Financial. Our show guests and their companies are not affiliated with nor endorsed by LPL Financial, Private Advisor Group, or Forge Wealth Management.